Hey everybody, and welcome back to Investing with Wesley. You know, when you're picking an investment product that's mass produced like an ETF or a mutual fund, there can be quite a lot of fees that you have to account for and look into. In today's episode, I want to explain to you the difference between a sales fee, management fee, and cover a couple of the other expenses you may have to pay in some of these ETFs or mutual funds. Let's get into it. Okay, so I've already made a video explaining to you what an ETF and a mutual fund is, but just for a quick refresher, an ETF and a mutual fund are both investment products that a pool of people can invest into, and then some investment manager in the fund will take that pool of cash and invest it into the market. Now again, I'm simplifying it a lot, but really the prominent difference between an ETF and a mutual fund is how the value is calculated. An ETF is traded over the counter market just like any other stock is. So the price can fluctuate wildly throughout the trading day, whereas a mutual fund calculates its share price at the close of business every day. So let's say an ETF and a mutual fund both are investing in the exact same portfolio, and that portfolio is doing really well. Throughout the day, you'll see the ETF go up, down a little, up, and as their portfolio in the ETF does well, so will the share price on the trading day throughout the day. Whereas in a mutual fund, even though the portfolio is doing just as well as the ETF, you won't see any sort of share price until the close of the trading day. Then they will update the share price to reflect the value of that portfolio. But honestly, how they work really isn't the point of this video. The point is, both of them are managed by somebody, and that somebody costs money. So how much money do they cost, and is it really worth it? Now, let's start with the ETFs because they're the cheapest and easiest to explain. An ETF is often invested in some sort of index. So because it's invested in an index means there's not some manager trying to buy and sell a bunch of different companies. They just match it to whatever this index is and let the index do the rest. Because of this, the fees or the expenses are extremely low. We're talking less than 1%. Now, this is considered extremely favorable for you, the investor, because it doesn't cost you a lot of money in fees. Mutual funds, on the other hand, do. Now, really, the point of a mutual fund is to try and beat the indexes or beat the market. And because the goal is to beat the market, you have usually a very big team of analysts and managers coming together to analyze a bunch of different stocks, bonds, and so on to invest in and then properly time when to sell. And needless to say, there's a lot more work involved to try and beat the market. And because this, as you would expect, there is a lot higher of a fee. Remember when I said ETFs usually have fees of less than 1%? Well, mutual funds usually have fees anywhere from 4 to almost 6%, with most mutual funds having a sales fee of about 5.75%, meaning whatever money you give them, 5.75% comes right off the top, assuming it's a Class A mutual fund. But the classes of mutual funds really don't matter. But just so you know, the classes really affect when the fee comes out. The fee could come out on the back end, it could come out front loaded like a Class A shares. That's really all it affects. The number of fee or the percentage is really unaffected by whatever class you invest in. So like I said, 5.75% of whatever money you give this investment automatically gets wiped away to a sales fee. Now, most of this money actually goes towards a commission to whoever the broker was that sold you on this mutual fund. Let me give you an example to really break it down to help you understand. The ClearBridge Aggressive Growth Mutual Fund, ticker symbol SHRAX, has a 5.75% sales fee. But between the management fee and the expense ratio, the net expenses on this investment or this mutual fund is really only 1.11%. So everything after that 1.11% usually goes as a commission towards the broker who sold you on this investment. And that's exactly why they call it a sales fee, because it's the fee you pay for getting sold this investment. Now, what is a management fee? Well, a management fee, if you haven't pieced it together already, is the fee you pay that investment manager to invest your money for you. In the ETF, it's part of that less than 1% because they're really not doing anything to your portfolio. They're just indexing it to whatever index they want. Whereas in a mutual fund, yes, they're actively trading, which is why the fee is much higher on the management's aspect. Like I said, in this mutual fund example, it's 1.11%. That covers the wages of all the managements, the analysts, and so on, as well as covers all the overhead for the prospectuses, the summary prospectuses, the fact sheets, all the marketing material that they use to try and sell you this mutual fund. Now, if you've been with this channel from the very beginning, you'll know that I used to be part of a brokerage firm, and then I decided to go independent because I didn't like what they were doing. And this is one of the big reasons I decided to do that. The only investment products that this broker dealer sold were mutual funds, and most of the time mutual funds are extremely heavy loaded on sales fees. Now, at the same time, this company preaches to do what's best for the client at every opportunity, which I totally agree with. But if we were supposed to be doing what was best for the client at every opportunity, then we wouldn't be trying to sell you these mutual funds. And let's use the exact same mutual fund to take a look at the comparison. This mutual fund is supposed to be aggressive growth to get you the highest rate of return possible so that the compounding effect is that much more drastic. Now, obviously that means a little higher risk, but if you're risk tolerant, then it's okay. This mutual fund is supposed to grow rapidly, and it's in its name, aggressive growth. However, if you look at the 5-year chart of this mutual fund, you can see that it's actually negative 31%. Now, if you look at the fact sheet, the prospectus, and any of the marketing material, it'll tell you that the index it's competing with is the Russell 3000. Now, if you decided to use an ETF or just invest in the Russell 3000 yourself, you would actually be up 87% in the same 5 years. So how does it make sense for me to sell you this mutual fund saying it's aggressive growth and it'll help you grow really quickly, and then have you pay me that 5.75% sales fee only for the manager in that mutual fund to be terrible at their job and not even keep up with the index? If I was doing something that was in your best interest, I would be telling you to invest in this particular index or the overall market itself, like the S&P 500. What's in your best interest is to just index the market and not try and beat it, and pay less than a fraction of a percent in a sales fee. Now, obviously, this is terrible for brokers and business and salespeople. This is one of the big reasons I decided to leave them and hop on here to YouTube. I wanted to teach you the right way to invest while not making you pay an arm and a leg to do it. Instead, YouTube is going to pay me their ad revenue in order to tell you this and add value to you. But also, in the spirit of honesty, it's not just all mutual funds are garbage and all ETFs are the way to go. Because there's some mutual funds out there that are actually very successful in what they do. Take ClearBridge Select Mutual Fund as an example. It's the same fund manager as ClearBridge, and its index is the same, the Russell 3000. But whereas the Russell 3000 has gone up 87% over the past 5 years, this mutual fund has gone up over 194%. So clearly they know what they're doing and they are in fact beating their index or beating their market. But it's also worth mentioning that no one can consistently beat the market for long periods of time. And mutual funds are intended to be long period of time investments. Now, if you don't know a thing about investing and you're using a broker dealer, by all means, there's nothing wrong with that. Just make sure to actually read the prospectuses they give you and don't just take their word, because some are shady salesmen and some are trying to give you the best that they can with what they got. Either way, read the prospectuses, figure out what they're indexing, and figure out if that mutual fund is even beating their index or not. Because if they're not, it's definitely not worth your money or paying those high sales fees. I hope you got value in this video. If you did, please remember to like and subscribe. I also hope that I helped educate you and helped enlighten you on the difference between the sales fee that you have to pay in a mutual fund versus the management fee that's in the expenses. If you have a question or comment or want to start investing yourself, I have a dedicated Facebook and Instagram account ready to answer all your questions. Or you could just leave a comment down below. Either way, the choice is yours, and I'll see you in the next episode.